What's going on, YouTube? I just wanted to spend a few minutes talking about an ETF that I personally like quite a bit, and that is FCOM, which is the Fidelity MSCI Communication Services ETF. This is an ETF that I like a lot because it allows you to get a large amount of exposure to companies that are fairly expensive at a fairly small price because this large ETF is broken down into just such small pieces. So the largest single company holding in this ETF is Alphabet, which is the parent company of Google, with over 23% of the ETF being in this company, with the only difference between Class A and Class C shares is that Class A shares has voting rights and Class C shares do not. And Alphabet is a company that I'm currently fairly bullish on because the largest company within Alphabet is Google, right? And during the current COVID situation, people are using Google very, very frequently, which is going to help them be very strong. But however, currently Alphabet is trading at a discount compared to its highs because Google as a whole is not making as much money because the main way that Google drives revenue is through advertising, and smaller companies just aren't advertising as much as they were in the past. But with that being said, though, people are still advertising, and once the situation passes, then I personally feel that people are going to be advertising more, which is going to help the price of Alphabet increase, and therefore the ETF. Also, Alphabet has more kind of venture-oriented, like companies, which I feel is a good thing because it provides a small amount of risk, but provided the size of Google and just how massive it is, I feel like it provides many great growth opportunities that could help drive their growth further, such as Waymo, which is a driverless car company, and Nest. Also, looking at FCOM, they also have a large amount of exposure to Facebook, which is interesting because Facebook makes money from advertising as well, but Facebook is currently having a record amount of usage, which is hopefully going to influence the amount of usage that Facebook is going to have going forward. And once the current situation ends, people are going to be advertising with Facebook more, which is going to help them make money. Also, this ETF has a large amount of exposure to various telecommunication companies, right? AT&T, Verizon, and Comcast. And they make a lot of their money by providing telecommunication services to us. But with that being said, though, cell phones and the like are only becoming an increasing aspect of our life, and 5G has the potential to be a large driver of revenue for these companies, which is something that, in my opinion, in the long term, is going to help cause a lot of growth in these companies, and therefore this ETF. But also, there's exposure to numerous companies in this industry. So, if for some reason, one company starts getting ahead of the other, you can still have exposure to that growth. And I know there are more companies than just these, but it still is good to have exposure to numerous ones, even though you're not exposed to all of them. Also, there is some exposure to companies like the Walt Disney Company and Netflix, which the Walt Disney Company is fairly being down right now with their parks being closed, but they're not but they're still fairly strong, especially because they're getting quite a bit of revenue from Disney Plus, and Netflix is experiencing a record amount of usage as well. And there are some other companies that are much smaller weightings in this ETF, but as you can see, the top 10 weightings can make up 72% of the portfolio. So the other companies in this portfolio isn't going to drive as much movement in the price of this ETF as these top 10 companies. As you can see, though, you are very diversified with there being 104 companies in this ETF. Also, this ETF has an extremely low expense ratio of just 0.08%. Additionally, it has a 1% dividend yield, which, although yes, not necessarily very high, it's good to see that it's there. Last note, as you can see, it is still fairly down from its highs, where in mid-February it was at $38 a share. Now it's at right at 34. So, I hope that this was of any use, if at all, and I hope that y'all like this video. Please like, subscribe, comment, and there is a link to a free stock from Robinhood in the description below. Thank you. Have a good day.